In our last video, we broke down the foundation, candle range theory, and the power of three. We talked about how every candle is more than just a stick on the chart. It's a range. It's a story. It's the market cycling through accumulation, manipulation, and distribution. But here's the truth. Theory on its own isn't enough. You don't build confidence by memorizing concepts. You build confidence by watching them unfold in real time. And that's exactly what we're going to do today. In this video, we're going to take everything we've learned, CRT ranges, liquidity sweeps, the session model, and we're going to bring it to life with real, live chart examples. I'll show you how to spot the range candle, how to recognize the manipulation phase when it's happening, and how to position yourself so you're not chasing the move, but anticipating it. By the end of this session, you won't just understand CRT and the power of three as theory. You'll see it as a living rhythm in the market, something you can read and trade with clarity. So grab your charts, follow along, and let's step into the live market to see exactly how the institutions set the trap and how we can ride the real move. All right, so for this example, we're going to be looking at pound sterling to US dollar, starting from the daily time frame. Remember, this process can be applied across multiple time frames, but for teaching purposes, the daily chart gives us a clear and clean picture. The first thing we need to do is identify and mark the extremes of the daily candle. At the very top, we mark the candle range high. At the very bottom, we mark the candle range low. These 2 points create the boundaries of our range. Think of them as the playing field where the market will make its moves. Now, why are these levels so important? Because they represent the zones where liquidity is resting. Above the high, you've got stop losses from short traders. Below the low, you've got stop losses from long traders. The market knows this, and it loves to reach for that liquidity before making its real move. So here's the basic logic. If price sweeps above the range high, we expect liquidity to be taken and then look for a potential sell setup in the opposite direction. If price sweeps below the range low, liquidity is taken there, and we then prepare for a buy setup back inside the range. That's the heartbeat of CRT. Sweep first, then trade the reversal. Now that we've locked in our daily range, it's time to zoom in for precision. The daily candle gives us context, but the lower time frames give us execution. So let's scale down to the 1 hour chart. On the 1 hour, we can start to see the internal structure of that daily candle. Instead of one bar, now we're looking at a full range of price action. Mini highs, mini lows, consolidations, sweeps, and reactions. This is where we confirm whether a liquidity grab has truly occurred, and where we begin hunting for our entry triggers. And remember, the rules stay the same. We're looking for price to sweep either side of the range, and then shift in the opposite direction. The higher time frame tells us the where, the lower time frame shows us the when. So let's break it down candle by candle on the 1 hour and see how price interacts with that daily range we just marked. This is where the theory turns into real trading opportunity. So after some time, we notice that price has managed to sweep the buy-side liquidity. Perfect. That's exactly what we were waiting for. Now, because liquidity has been taken, we already know that our directional bias shifts to the downside. In other words, we want to sell this market. But here's the key point. We don't just sell blindly. We need valid entry reasons. So let's look closer. Right here on the chart, we can clearly see an inefficiency, what's known as a fair value gap. This is the imbalance left behind where price moved too quickly without offering proper trades on both sides. And right above it, we have the very candle that created this imbalance. That's our order block. So here's the game plan. We mark the order block at the top, and this becomes our area of interest. We don't chase the market, we wait. Once price retraces and taps into that order block, that's our green light to pull the trigger on a sell position. This is a smart entry because it aligns perfectly with both the liquidity sweep and the inefficiency. Now let's talk targets. Our main target is the sell-side liquidity, the lows resting beneath the market. That's where we expect price to gravitate. But here's some practical advice. You don't have to hold your entire position until the absolute low is taken. To stay safe, you can scale out, take partial profits along the way, or even close early if you see price slowing down. Flexibility is everything. The market doesn't care about your plan, it does what it wants. And after just a few days, boom, price drops and smashes through our target. This particular trade took around 4 days to fully mature. And that right there is why patience is absolutely critical in trading. Too many beginners think this game is a fast track to riches. They want instant results, instant profits. But the reality? Trading is more of a mess around and find out type of business. If you're reckless, the market will humble you very quickly. And I know some of you are probably wondering, does this setup happen every single day? The answer is a big no. This exact trade took 4 days to play out. And that alone should tell you that the market doesn't serve you the same opportunities every day. And honestly, why would you even want to force a trade every single day? That's how people end up overtrading, losing discipline, and blowing accounts. The real edge comes from waiting for clean setups, aligning them with your rules, and then executing with confidence when the market finally gives you what you've been waiting for. That's how you build consistency. Not by chasing every candle, but by letting the market come to you. All right, so on the same chart, let's look at another example. Same process as always. We start by marking our 2 points, the candle range high and the candle range low. These are our liquidity points. What do we want to see? We want price to either sweep above the high or below the low. Simple framework. Now let's flip down to the 1-hour time frame. Here's what we see. Price has just taken out the sell-side liquidity. And this right here, this is your manipulation phase. The market is basically sending a false signal. It makes it look like price is breaking lower, tempting sellers to jump in. But instead of continuing down, price immediately reverses and rockets to the upside. Classic trap. So now the big question, do we just buy right here? Or do we wait for confirmation? Maybe an order block, maybe a fair value gap? The safer option is always to wait for confirmation. That's how you protect your capital and keep your trades high probability. But here's the tricky part. In this particular example, price just takes off without giving us any clean confirmation. No order block entry, no obvious fair value gap to work with. We knew the direction was bullish after the liquidity sweep, but the market didn't give us the textbook trigger. So does that mean this is a lost trade? Not necessarily. Some traders will take a chance here, especially if they've got the conviction and the capital to manage the risk. They're essentially trading the raw liquidity sweep. And if you have that experience and risk tolerance, that's fine. But for beginners, my advice is clear. Stay safe and wait for your confirmations. Because here's the truth, opportunities will always come back around. Missing one move is not the end of the world. But blowing your account because you couldn't wait for a proper setup? That is the end of the world for most traders. Patience and discipline will always pay you more in the long run than FOMO entries.